Hello there, and welcome to NCBA's Money Mastery, where we teach you how to make your money work for you. My name is Daniel Macau, and I am excited about numbers that matter to you. Now, here are some numbers that matter with regard to active and passive investing. 91% of East Africans have spent more than they earn. 91%. 70% of East Africans have absolutely no income upon retirement. And four is the number of products that you can invest in through NCBA's Investment Bank: shares, derivatives, bonds, and rates. Now, at the core of money relationships, there's a constant desired outcome that our money would work for us. But very few people actually achieve this. A good investment vehicle frees you up from day-to-day decisions on your investment, allowing you time to focus on things that matter to you. This morning, we'd like to show you ways that you can gain mastery of the dynamics of active and passive investments, taking advantage of the numerous products and options that we have at NCBA's Investment Bank. My guest today is Samuel Gichohi. He is the head of business development at NCBA's Investment Bank. Samuel, welcome to Money Mastery.
I'm humbled. Thank you for having me.
Well, Samuel, I think we should start by understanding a couple of terms here. What is portfolio management, and what would be your ideal approach to portfolio management by a client?
Right. The number here is 2. There are 2 ways to portfolio management for a client, and this can either be passive. Passive means that the investor puts their money in a fund or a managed asset, a managed fund, where their funds are managed without them having to make any decisions. And then, of course, there's the active, and the active is where the investors will put their money in an investment, say like shares in a stock exchange, a stock market like the Nairobi Securities Exchange, and those decisions, they are involved to a certain extent in the decisions that are made in terms of buying and selling, with the help of the financial advisors who sit in the background. So the decision is made by the investor with the help of the financial advisors, depending on the sort of risk they're willing to take, the disposable income, how busy they are, and what sort of ability do they have, the ability to monitor their investments, or do they feel that they would rather have it just be monitored by someone else? And of course, there's also the element of how investment savvy. We have many more what we call sophisticated investors these days, and so we have a lot of people who are also very comfortable managing their own portfolio.
Right, you've talked about investing for clients, and perhaps if you could walk us through the categories of clients that you handle when it comes to investments.
Well, they're different to an extent on the passive and the active side. With the passive investors, we usually have the categories in retail investors. Retail investors are individual investors, chamas, corporate investors. All those will fall under the retail realm. And then we have institutional investors. Institutional investors are those funds that are managed, and so you find insurance companies will usually have funds, and those funds will be managed by a fund manager, and therefore they are considered institutional investors. They still invest in the stock market and bonds and shares and other types of investments, but generally these are managed. On the passive side, we also have what we call high net investors, and these are high net investors will be investors who have large amounts of money that they would like to invest passively, which they put in some managed or even private wealth funds, which will be managed so that they're able to take advantage of different types of investments. On the active side, of course, we have the same sort of institutional, retail, we have local and foreign investors, and they fall under different categories depending on either geographical location or size, or of course the amounts that they invest, which is where we also have the high net investors and the ultra high net investors.
So Samuel, for many people watching us right now, the first question that comes to mind is eligibility for their preferred choice of investment. Are there caps in terms of minimum? Is there a minimum level for investing?
We don't have caps per se. We don't have caps per se. For example, in shares, which is the active side of things, we have a 100 shares for any counter that you can buy, and we have shares that are as low as 1 shilling. So it means you can actually be able to get into the market with less than 100 shillings. In the fixed income and the bonds market, the minimum is 50,000 shillings in any bond, and you'll find that in the other funds like our money market and unit and equity fund, the decision is not necessarily the amount you're investing at any point. It is more the suitability of the investment to the client's investment needs.
All right, that's a great step towards financial inclusivity. Perhaps you could describe the nature of brokerage services offered at NCBA's Investment Bank.
The nature of brokerage services we offer are generally the access to the Nairobi Securities Exchange. We also give you access to the different markets in the region, so you can access Uganda, Rwanda, Dar es Salaam. We are generally in the area of in the business of brokerage, which means we are the ones who trade any trading decisions made by investors. We are the ones who do the trades on the Nairobi Securities Exchange. And of course, we offer online and mobile platforms which allow investors to be able to access the market directly. But the key and the main offer that we feel adds value to the clients is our research offering, which means we are able to ensure that investors are getting consistent information and in a timely manner, which will allow them to make investment decisions. In addition to that, of course, there is the interactivity where we ensure we have our clients have access to us through email, phone calls, and they have our phone numbers so that we can be able to advise them in terms of what decisions are best based on the type of portfolio they have, their risk profile. And that brings me to the risk profile itself. It is a discussion and usually a set of questions that we usually try to take the client through so that we are able to tell what is their time horizon, how long do they intend to invest the funds to make what return, what they're looking for, and also how much they know, how savvy they are in terms of investments, so that we can be able to match the correct investments to their investment style and their risk profile.
All right, if I could follow up on the statement you made there about research, perhaps you could tell us what parameters you look at when you're advising your clients on the specific stock to buy.
I think the initial issue is with the client's profile and with the client's needs. How long do they intend to invest? What kind of risk? And what happens is, if you look at the available securities on a market, or even if you're doing passive investment, you will find that on the financial management side of our business, what happens is that they have a more risky investment, which is in the equities fund, and then they have the low risk investment, which is the money market fund, and of course they have the dollar fund. On the securities side, we look more at what is your risk level, so that we are able to provide the client with a portfolio that either, if they're very risk averse, then we'll be looking to give them a defensive portfolio, which will be heavier on fixed income or bonds, which means that they are more protected. Their principal is more protected, and much lighter on the side of equities and stocks, which tend to be more risky. We have the middle, which is the growth portfolios, which means that we have a balance of both. This is for the less risk averse, and then there's the really high risk investors who you will find are very happy to do day-to-day trading, and these ones will tend to take on very volatile stocks, and they are usually very savvy. But this now means that on the research side, we are able to value stocks and look at the different technical things like the graphs, the movement of the price, in order to be able to tell a client that this suits the kind of investment that you want to do. Some of them will be quite stable, some of them will have quite a good growth curve, but there's those ones that are very volatile. And each different type of portfolio will suit a different need.
Right, thank you, Samuel. Perhaps you could also share with us the trends that you notice when it comes to the sectors that your clients are interested in investing in.
Yes, our market is skewed towards two major sectors. This is tech and telcos, and that's technology, and banking. These two are the biggest and the most active. In the past, we saw a lot of activity in the manufacturing and services sectors, but over time, as the population got more banked, as foreign investors started to take a bigger role in our market, the sort of deal sizes they look for, they tend to find in the banking sector, and of course telcos, which means we are talking about the likes of Safaricom, and the bigger banks, the tier one banks especially. And this is mainly because our market is almost 60 to 70% foreign controlled, and therefore you'll find that where the foreigners tend to trade more will be the sectors that tend to have a lot more liquidity. However, we find that in as much as foreigners will have quite a say, even local investors and retail investors will tend to be quite focused on these sectors. And we do see quite a bit of activity outside these sectors in the likes of East Africa breweries, BAT, and we will see, then that's more in the manufacturing side, which tend also to be quite active.
Right, thank you for that. Let's talk about our current reality today. COVID pandemic globally, and unprecedented disruptions for investors, for businesses. We're having to close down businesses. Lots of people have been unable to meet their obligations. Are there any concessions that the bank has made to cushion its investors from the adverse effects of this pandemic? Is there anything that we've done to cushion them?
Well, from the point of view of the investment bank, we found ourselves in a very interesting position. COVID came with the realization by much of the population that there is a need to invest because there was job losses, there was change in the sort of businesses they do. There was more need for passive investing because there was a lot of, say, working capital that became idle as certain businesses came to a standstill. So there was people restructuring their portfolios because the market also shifted significantly. And for this reason, we had to also realize that there was quite a bit of a weight on what was the traditional methods of interacting with our clients, which was we had a lot of walk-in clients and one-on-one meetings, and now everything was going digital. So the one thing that we did was figure out how do we reach our clients and keep them, informed, and also be able to interact actively with them. And for this, we were very fortunate that we had already launched our online and mobile trading platforms. We also had quite a presence and the ability to communicate with most of our clients, both on SMS and on email. And we started now also to pursue other ways of talking to our clients and disseminating information and knowledge, which is where we also started doing a lot of meetings. Of course, these meetings which are online, and in order to be able to give our clients consistent and constant information to be able to help them to make the correct investment decisions.
Right. Thank you, Samuel. As with any great product, there's always barriers to entry to any market. And my question to you now would be, what have been the barriers that you currently face when it comes to the Kenyan market?
I think the biggest barrier historically has been geographical. Most financial and investment services are centered in Nairobi. And so that means that most investors under the traditional methods of communication and investment had to either to come to Nairobi to be able to even carry out any investment issues. Of course, over time, and as the Nairobi Securities Exchange moved from now the manual trading systems to automated trading systems, and also we have CDSC, which now is a database that holds all the securities, then we were able now to launch online and mobile platforms which enable our clients to reach or to be able to trade from wherever they are. But the now other barrier that comes up from all this is now knowledge and investment savvy investors, because we don't have a very big pool of sophisticated investors. Traditionally, most investors would just invest for dividends. They'd put money in the market and just sit back, and the shares would rise and fall, and they would not take advantage of those capital gains. However, now we are able, using forums like webinars and research offerings, to be able now to break those barriers. It's still a work in progress. We are still working with the likes of the Association of Stockbrokers and Investment Banks, so that as a group we are able to come up with ways in which we can break these barriers. We don't have curriculum which is dedicated to investment, and so there's a lot of ignorance out there that we need to do to change from a saving culture, which is still also quite weak, into an investing culture, which can also boost the saving culture.
Thank you for that. And my next question would be around investing as a group. How different is it, investing in groups? And do chamas qualify for what we refer to as institutional investors?
Well, chamas tend to start small as group of friends who are pulling money together to reach a certain investment goal. They can grow, and we have seen certain chamas grow and reach points of being institutional investors. However, at the onset, they're still in the retail pool of investors. The advantages of investing through a chama is, of course, in the economies of scale, because when you have pooled funds, you're able to diversify your portfolio better. Most of the challenges that chamas face is in terms of how they are structured. And a lot of chamas will tend to just be a group of friends. They are from different backgrounds, they have different risk levels. And so decision making becomes a problem. So as a brokerage and as investment advisors, what we do is we try to advise these chamas and to come up with what we call an investment committee and come up with an investment strategy with which now we are able to structure a short-term, medium, and long-term strategy. For example, if they're intending to go into real estate, which is capital intensive, we look for what they can do in the short term so that whatever funds they are working for them. For example, putting them in a money market fund where they're always earning an interest, and then maybe looking at how do we protect that principal and maybe use that interest to start taking a little more risk in investing, say, in shares, which are a little more risky but can give them also higher returns, so that now we sort of boost what they're putting away and make sure it is always working, with the ultimate goal of, say, reaching the capital intensive level of going into real estate.
Right, thank you, Samuel. And I'd like to now go back to a statement you made earlier on technology. And I think we can all attest to the fact that technology has been a huge business enabler, especially during this pandemic. And I know you mentioned a little bit about technology, but maybe perhaps we could go a little deeper there. What is the place of technology in your activities as an investment bank?
With the pandemic enhancing the need for technology, we have realized, but we have seen how much more important technology can be, especially in a situation where investors' movement is curtailed. And it has actually cemented our notion that technology is the future. You will note that we had already a mobile trading platform, which you can use on your mobile wherever you are on the globe, which means even diaspora clients can invest actively on our market, on mobile and an online platform. Now that gives them real-time access to prices, stocks, market depth, where demand and supply is on the market, so that they can be able to trade, put orders and trade. I think the other part of technology that has really helped is the ability, the money transfer platforms, because now people are able to fund their accounts, say, through M-Pesa from wherever they are. In the past, you had to physically go to a bank, deposit money, and bring a pay slip, and then somebody would credit the money, which is a very long and tedious process. But now with technology, wonderful things are happening. We are able to reach more clients using these webinars and discussions, which in the past you could only get a group of, say, 50 or 100 people. Now you are able to have a webinar where you can access hundreds, thousands of people, and you can get questions and answer them in real time. So I think technology is, in essence, the real enabler for efficient trading on a market. The reason being, everybody getting information at the same time and acting upon it and being able to act upon it is key to an efficient market and price discovery. When some people are getting information in the rural areas much later than the people in the city, it gives those ones in the city an upper hand. Now technology has leveled the playing ground, and that is the direction we are going. We are also looking at how we can now ensure that investors can open accounts from wherever they are on the globe without any physical documents being submitted. Of course, this will enable even those in diaspora and those in far-flung places to be able to access investing activities.
Well, thank you so much for that. You've talked about technology, you've talked about how we are supporting even those that are in the diaspora. And now I'd like us to take a quick break. When we return, we'll be answering some of the questions. So those of you, please, online, send us those questions, and we'll be tackling them shortly after this break.
Candace, what's that?
I brought you a small bonus.
Bonus for what?
Daddy said you helped us get a house, a car, and Mommy's business.
But I only helped them get the loans.
You did more than that. You got us 299 family dinners, 64 kisses on the cheek, 12 road trips to see Grandma, 42 jokes from Daddy, 49 laughs from Mommy.
In over 60 years of dealing with numbers, we've learned that the numbers that matter the most to you are the ones that matter the most to us. NCBA Bank. Go for it.
Well, ladies and gentlemen, welcome back to Money Mastery from the bank that says go for it. I've been speaking to Samuel Gichohi, Head of Business Development at NCBA's Investment Bank, and we've had quite an interesting conversation so far. And I think, Samuel, I'd like us now to begin tackling some of the questions that are coming through from our viewers. There's a question from David. He's asking, what are the requirements for setting up a CSD account? Is it online?
We are almost at the online stage, and thank you for asking that. We are already working on the system, so in the next few weeks, you should be able to open an account online without any physical interaction. At the moment, only bank clients or those who also have an NCBA bank account can be able to use scanned forms, and once they fill the forms and send us their ID, PIN, and photo, we are able to use those scans to be able to open an account. For those who are entirely just brokerage clients who do not have any NCBA bank account, then we would need to have those physical forms submitted at any branch country-wise. And that is the CDSC account opening form, which also opens the brokerage form and the online trading form. And once you have filled those, we set you up on an account. We set you up on an online trading account, which now accesses your shares in CDSC as well as the Nairobi Securities Exchange, which allows you to access the market in real time, access your statements, access your portfolio valuations, and be able to make buy and sell orders and see demand, supply, and the market movement in real time.
All right, thank you for that. There's a question from YouTube from somebody by the name of Noah. The question is, how can retail customers access the trading platform?
Well, of course, the first step is to open an account with NCBA Investment Bank Brokerage. That is by filling, of course, the account opening forms. We open for you the CDSC account form, and in the process, as we open the CDSC account form we then set you up on the online trading platform. And once you're on the online trading platform, then you can access all trading, buy, sell, and real-time information on the market.
All right, so thank you for that. There's a question from Moses, and the question is around taxation. So the question is, if you could explain to us, where does tax come in terms of the different types of investment?
Tax comes in usually in the form of withholding tax on the returns that you have made, which means, for example, in shares, it is in dividends. So the withholding tax on dividend for local retail clients is 5%. On foreign investors is 10%. The withholding tax on bonds above 10 years is 10%, and below 10 years is 15%. Now, this withholding tax is usually charged at the point of payment of the dividend. So it is already, your return is usually paid to you net of the withholding tax, which means it is you don't need to declare it because it has already been settled by the payer.
All right, thank you. There's another question from a handle Vibrant Market Connections. The question is, what to invest in and how to start? This person wants to know, how do I start and what do I invest in?
The first step is to open, of course, a CDSC account. Of course, if you want to invest in bonds, then you will also need to open a CDS account with Central Bank. That we don't do internally. You will need to do it at Central Bank and then map the account to us. We assist you, of course, in the process. So we are happy to assist in whatever you need to do to be able to open those accounts. The extra documentation is ID, PIN, and a photo. Now, once the account is open, you will be assigned an investment advisor, and that's the person with whom you will now pick up the discussion of your investments. And at that point, we will now start discussing how much disposable income do you have? Is it a one-off investment? Maybe you've come across, a lump sum, or is it something where you'll be putting small amounts every month? What is your risk profile? What sort of risk are you comfortable with? What decisions would you make in a situation where maybe you make some losses? Then once we have that and the time horizon in which you're going to be investing, we are able now to structure a portfolio that is, from either defensive to speculative, or sometimes we may find that someone is risk averse and they don't want to manage the decisions. So we now then go and open a money market fund or an equity fund, which will be managed without them having to make any decisions. So this is really the sort of process that we go to in making a decision on what do you invest in, because what you invest in is directly connected. If you're risk averse, then you will have more bonds, for example, which are risk-free, and you'll have more defensive shares than somebody who is speculative, who is just looking at day-to-day price movements.
All right. There's a question coming through from Josephine Dikwe on our YouTube channel, and the question is, can I open a bond and treasury bill trading account with you? As
mentioned earlier, the bond and the treasury bills trading is done through Central Bank of Kenya, CBK, and they have a separate CDS. Notice the one for shares and corporate bonds is CDSC, Central Depository and Settlement Corporation. Then there's CDS, Central Depository and Settlement, which is run by CBK, and that you need to actually approach CBK yourself and open the account, which is then linked to your bank account, which is where the returns on your investment in fixed income securities, which is bonds and treasury bills, is going to be to go. Now, and then of course, when you withdraw. Now, once you set that up, we will also now help you. You will need to have a brokerage account, which we map to that CDS account. So that now, rather than having to make your orders directly to CBK, you can make them through the broker, and we can be able to execute your orders for treasury bills. For bonds, really, treasury bills are usually headed to maturity.
Okay, thank you. There's another question coming through on our YouTube channel from Dora Munjaru. The question is it possible to get investment options data to compare before we come to you for advice from an informed perspective?
Of course, I think we are happy to do that. We'll usually have most of our stock picks and reports uploaded on our website. We also can send them to you via email so that you can be able to see what sort of investment reports we do. We do industry reports, we do sector reports, we do company coverage. We also do stock picks, which is now the month-on-month analysis of what is going on in the market and how is it affecting certain stocks and which ones do we think are buys or sells or hold in a certain situation based on our valuations. We also send you daily, weekly market reports, which are to assist you to now see the day-to-day speculative activity on the market. And yes, we are happy to share that.
All right, another question from Josephine Dikwe, and she's been quite active. Thank you for engaging with us, Josephine. What are the charges for managing my investment?
Well, for the passive investment on money market, I think it's 2% of the portfolio value. That's annual. For brokerage, we are actually governed by the tariffs that are given to us by our regulators. Remember, our regulator is Capital Markets Authority, and so the retail investor will usually pay around 2.1% on the value or traded. Of course, that changes as it goes higher. For example, up over 100,000 shillings, I think it goes to 1.72%, and above $1 million, it will come a bit lower. And then there is, of course, on bonds is 0.05% of the value traded.
All right, thank you very much. There's a question coming through from Facebook as well, from Adina Grebovic. The question is it better to invest lump sum or diversify your investment in accordance with the current times that we're in?
Well, that's a very good question. What happens is that when you're dealing with a lump sum, there's a risk of timing. Because if you come with a lump sum and say, I'll give you a very recent example. If you had come with a lump sum to invest in the market just before coronavirus hit, you would have found certain of the shares that we would probably have considered growth stocks at that point, at a point where we didn't think they were overbought. So they were still buys because our valuations were showing they were going to continue growing. But because we could not foresee the effect of corona, and neither could we foresee corona, then our reports and our valuations, of course, were not factoring in that sort of situation. So chances are, if you had come in with a lump sum, you would have been buying something like KCB at 55 shillings. You'd probably have been buying Safaricom at 40 shillings at the time. Now, coronavirus hit, and of course, within about 3 months, the same shares that were at 55 had gone down to roughly 32 shillings for the banks, and Safaricom was, I think, at something like 24 shillings. So if you had put a lump sum, then chances are you would now be stuck, because the amount of money you have put, it would mean that the only way to be able to take advantage of the downside, because you can also take advantage if fundamentally the companies were still strong and the share price had gone down. What we do is we average down, keep buying as it goes down, so that when it reaches bottom, you have brought down that initial price to a certain level, which means that you would need to have some extra cash to be able to pump in, to be able to bring that price down. So that can cause what we call a timing problem with a lump sum, which then we really, if you're doing a lump sum, we really need to remember that there is that possibility of an unexpected external event affecting otherwise very strong shares. But the fact that we know they will recover means that we continue investing in them on the downside. Now, when you're investing in, now say every month you're putting something, then there's now that advantage of timing, because what happens is, of course, if you had gotten into the market at a low, which was something like last year in June, July, then it means if you had come in with a lump sum, you'd be laughing all the way to the bank right now. The timing would have been perfect. Now, for somebody putting in small amounts or regular amounts, what happens is then they would have bought just before maybe, and then kept buying, because fundamentally these stocks were still very viable. And we have seen that they've come back, say, from those levels of 30 shillings to now over 40. Safaricom has already recovered back to the prices it was at before the pandemic, and even actually gone higher. So that means that all along our valuations told us they would recover. The question was when, not if, and therefore it gave investors the opportunity to keep investing, so that they would take advantage of both the downside and the ability to keep investing. So again, it depends on the timing. So both of them have their advantages.
Really good response to a really powerful question from Adina. Adina, we see you. Thank you for engaging with us consistently every week and being very active in the questions there. There's a question coming through from Waihura on, I think that's YouTube. They're looking to invest, and they're wondering what would give them some good returns, and looking to invest 300,000. And they're wondering, is it a good start?
Yes, there's never a bad start in investing. It's not how much you invest, is what you do with the little you have. And so it's the decisions that are behind the investment. Of course, I can't quite just tell you certain shares, because the decision to invest in a certain counter is based on the compatibility. So I would really like to engage you on a one-on-one, so that I understand first your investment style, your expectations, and the time that you intend to invest, and that way we are able to match you to certain stocks. However, that said, we still are in a buy zone with most of the stocks that I mentioned, especially in the banking sector and the telco sector. And so, because most of the stocks are in recovery mode from the hit that they got from the coronavirus, and the economy, what happened with the economy during that period. And now, as we see foreign investors especially starting to come back, to trickle back into our market, they're now pushing the prices back to the levels they were. So even if I was talking, say, of a share like the banks, you find some of them had gone down to something like 30, they're at 40, but they had come from 55, which means if they're going to go back to that level, you still have quite a lot of upside on them.
All right, thank you so much, Samuel, for joining us on today's conversation. That's all we have time for today on this season of Money Mastery Conversations from NCBA, where we teach you how to make your money work for you. To learn more about our products, please visit our website. That's ke.ncbagroup.com. Or better yet, call a number that's scrolling at the bottom of your screen right now. We would also like you to please follow, like, subscribe to our social media handles, which are also on the screen in front of you. And so till next time, when we bring you another set of numbers that matter to you, my name is Daniel Macau. Goodbye and stay safe.